what fundraisers need to know about accounting. I'm Rebecca Lamb. I'm the president of the AFP Greater Houston Chapter, and I am pleased to introduce this morning's speaker. I'm going to get right into it so that we can get to the presentation and have as much time as possible for questions at the end. So our speaker today is Mimi Holt. She's an audit partner with Blazek Vetterling, where she has spent the last 26 years working exclusively with not-for-profit organizations. And her clients have included religious organizations, schools, arts organizations, foundations, social service organizations. So it runs the gamut of nonprofits. Mimi leads the firm's accounting and auditing standards technical resource group. And she is a certified public accountant and a member of the AICPA, the Texas Society of CPAs, and the Houston Chapter of CPAs. So Mimi, thank you so much for joining us this morning and bringing your knowledge and wisdom. I'm going to turn it over to you. Thanks.
All right, well, thank you. I am going to attempt to do my screen share and start my slideshow. I'm an accountant. I like paper. So let's see if we can get a slideshow going. How's that? Okay, well, welcome to my living room. Thank you for braving the rain and the traffic and being here with me this morning. And I think I'm fairly brave also because I count something like 60 of you out there. I'm an accountant, so I can do that. And so something like 60 fundraisers in my living room and one accountant. So here we go. Let me try to just let you know what I'd like to share with you this morning as an accountant. I want to give you my perspective on, you know, how do accountants count and recognize contributions so that you get an understanding of what we poor accountants are going through so that we poor accountants can get a better understanding of what you fundraisers are going through and what you need. I want to talk about practices that could help you to reduce confusion between your accountant and you and make things flow a little more smoothly. And that's a tall order, but I really think it can be done. I want to talk about how we can support each other's efforts in both being fundraisers and accountants. How do we support each other on that? And also, how do we communicate the story of the organization? Because after all, that is what we are here to do. All of us have a commitment to our organizations. I don't work for a not-for-profit. I'm an auditor, a dreaded auditor, but I care about not-for-profits. That's why I am doing what I am doing. I get to vicariously do good by auditing my clients and seeing the good that they do. So I want to partner with them. Not-for-profits are businesses. It's very important in our community that we remember that. And as a business, we have a story to tell, and we need to be good at telling that story and being able to communicate our needs to others. There's a lot of competition for dollars. Dollars are limited, and right now in this environment with COVID, dollars can be even more limited and more difficult to get your story out. Accountability is important. We must be accountable. People have choices in how they spend their money, how they gift their money, how they use their resources, and we need to be accountable to them. Bad PR, good PR has such an impact. A not-for-profit story, it's about their past, but it also has to be about their future. It's the story of financial flows and stewardship of resources, and but it's the hopes and the dreams and the plans of an organization. But to have a complete story, all of that has to be woven together, not necessarily in a single place, but in a cohesive way so that the people that we're telling that story to understand it and that we can get them to buy into it. So a not-for-profit story is told in tons of different places. You know, you've got the website, you've got an annual report, fundraising brochures, all over the place. And the not-for-profit itself has control over some of these resources, but not necessarily over all of them. You know, a lot of your information is appearing on GuideStar and Charity Navigator and other places, the Better Business Bureau, where they are gathering information and they may be evaluating you and they may even be rating you based on that information that's out there. So it's an important question for all of us is, what are others seeing when they look at these documents? Are they seeing transparency? Are they seeing contradiction? Are they seeing a lack of focus, or are they understanding what our organization is actually out there to do? All of these documents serve different purposes, so they're all important, and they're not going to be exactly the same. But overall, do they provide a clear vision of the organization? Or are they a cohesive story? Are they a collection of little vignettes that are semi-related and sometimes not very related at all? We don't always get a second chance to make a first impression. So when someone picks up a document about our organization, we want to make sure that that document will make them want to know more, not make them toss it aside and say, not really interested. So it may be the financial statements that are first thing that are picked up by someone, or whether it's the first thing or the second thing, we want those financial statements to be able to tell the story in an appropriate way that accountants tell that story, which is not the same way that fundraisers do, but accountants are not the best storytellers. In fact, as an auditor, when I hear someone talking about storytelling, I think fraud, untruth, I think there might be a problem. So we've got this automatic, as accountants and auditors, we sort of have this automatic reaction to storytelling that's not necessarily good, but we really do need to be good storytellers. So I would say we need to, as accountants, rely more on the fundraisers who tend to have the ability to make the case, to tell the story of the organization. And we need our fundraisers to look at our financial statements, tell us what they're seeing, tell us the questions they're getting from donors and from foundations that maybe we can address in the financial statements so that those questions don't arise. Okay, we've got the hunter-gatherers and we've got the accountants. You know, for millions of years, give or take a few, there's been some tension between accountants and fundraisers. Why? Why is this? Why is this oil and water? Why is it, you know, that we just can't get along? Well, you know, there is a basic contradiction. You have the producers, the fundraisers who go out and actually bring resources into the organization. And then you have us accountants that really just kind of use those resources. We count them and we use them. So maybe there's just a systemic difference between all of us that we need to acknowledge and to see. But I would really tell you, I think that fundraisers can't be successful without having good accounting and good reporting behind them. And accountants cannot be successful in producing that good reporting unless we have the input of the fundraisers. So whether it's the fundraisers or the accountants that represent the yin or the yang, I leave that to you to make the decision. You know, the yang is the positive and bright, and the yin is the negative and the dark. So I guess I sort of know where I think we accountants fall in that, but and where you fundraisers do. Great deal of respect for all the positivity. But regardless of where we fall in those traits, they're interconnected. Every positive trait has a negative and vice versa. We've got to be able to reduce the tension that's inherent in our differences so that we can actually together bring some harmony. I'd like to be a peacemaker. Like to be an air traffic controller who gets people where they need to be without crashing into each other and having disagreements. So that would be, I think, a success if we can understand each other's differences, respect them to the degree that we're able, and realize that without each other, we really are not going to be successful in our efforts for the organization. So a basic question comes up. You have a fundraising campaign, or you're just looking at your budget this year. It's like, well, how much did we raise? Well, the answer to that question often depends on whether you ask someone in the development office or you ask someone in the accounting department, because we count contributions differently. But when we don't give the same answer, we have to have an understanding of why. Because if we don't have an understanding of why, and if we can't communicate to donors, to governance, to management, why development has one number and the accountants have a different number, then we are reducing our credibility overall for the organization, and we're just not being helpful. And we could lose our audience. And whether that's your board or your donors or the communities, we don't want to lose our audience, because you won't be able to be successful raising funds, and I won't have a job as an accountant because there'll be nothing to count. So before we talk about why there are differences, let's just take a moment to accept that there are differences. We count things differently. We see things differently. We have different objectives. We have a different language. Absolutely, we have a different language. But we need to become bilingual if we are going to be the most successful that we can for an organization. When we look at things, we look at the timing, the valuation, verifiability, the conditions that go along with contributions. Those are the kind of things that accountants look at. Fundraisers have a different measure. And I don't want to say all fundraisers have the same measure or that every campaign has the same objective in measuring. So that's something that the accountants need to be instructed on, while I'm taking this time to instruct the fundraisers a little bit on what we're thinking of as accountants. So as long as we can identify those differences and explain them, that's a process we accountants call reconciliation. So we want to be able to reconcile our differences so that we can be peacemakers in this world. Okay. The definition of work that's used in physics is force times distance equals work. So no matter how much force you put into something, if there's no distance covered, physics says there's been no work. So you can see this team here, and they appear to be putting a lot of force into what they're doing, but they really aren't making much headway because they're rowing in opposite directions. They seem to have missed step one. Where are we going? We all want to be successful. And we generally know what direction we want to go in, but we don't always know how to get there. And accountants need to talk in plain English using non-technical terms so that we can help the entire organization to row in the same direction. But we can't do this alone. And this is not a moment for finger pointing at who's right and who's wrong. It really is just something that I can appreciate so much, how difficult it must be to be a non-accountant and have to deal with accountants. But I also want you to take a moment and think about the other side of that coin, that we accountants, when we're trying to be realistic and get numbers and get answers, and we are dealing with people who are visionaries and who are wonderful at what they do. I don't like to ask people for money. That's something that I leave to the people who know how to do that and how to present the case. But we need to find a way to be bilingual and to work together and row in the same direction. Okay, warning, I'm about to get a little technical. Okay, so one of the reasons that no one understands us accountants is we talk in acronyms and jargon. So I'm going to talk about GAAP and I'm going to talk about FASB. Financial reporting has to have some uniformity if it's to have any meaning and comparability to people who are looking at it. So when I'm talking about accounting rules and standards, I'm talking about GAAP, generally accepted accounting principles. Those are the rules. If nothing else, accountants are rule followers. Many people think accountants are like math. I hate math and I don't know anything about math. I have a calculator if I need to do math. What I know is rules, and I know how to apply those rules, and I hope I know how to be creative in applying those rules so that I can communicate what's really important. But GAAP is what tells us what those rules are that we need to follow. And there's been some changes in the rules lately for GAAP in the last couple of years that have changed the kinds of information that we need to have and have sort of changed the emphasis. And so I want to talk about those rules. And I wish I could tell you that having rules means everybody will always come up with the same answer, but that's just not realistic in life. There's always judgment. And your accountant's judgment is to a large degree, it's impacted by the facts and circumstances. Those facts and circumstances are the information that typically, when it comes to a contribution, the fundraisers have that information. The accountants don't generate this information. They need to get that from the fundraisers so that they can have the best financial reporting practices. We're not involved in the transaction, so we need you all to make sure we have the right information so that we can do our best financial reporting. For more than 25 years, FASB, is that acronym, that's our Financial Accounting Standards Board, has recognized the primacy of fundraising efforts and donors in the whole financial reporting of not-for-profits. There are no owners in a not-for-profit. The primary stakeholders of a not-for-profit are its donors. So, a bow to the fundraising community. We really think it is all about you, but have a feeling nobody's told you we think it's all about you and your fundraising efforts. So spend a little time talking about that. There's specialized accounting for not-for-profits that isn't used in other organizations. And primarily that has to do with our contributions and reporting of those. And there's a whole lot of aspects of contributions. We have to distinguish those from other transactions. We have to evaluate when we recognize those in the financial statements. That's when do we put the number in the financial statements? We say it's happened, so we put the number in there. We have to determine the classification. You get contributions that have no restrictions on them whatsoever. Use it for whatever you'd like. But then we have a lot of contributions that come in that the donor has stipulated the time or the purpose that contribution funds can be used for. And so we need to distinguish that because it's reported very differently. Again, that's the emphasis on financial reporting on the donor, is reporting that differently depending upon whether the donor has stipulations. We need to recognize, once we recognize that there might be restrictions, is we also have to recognize when those restrictions are satisfied. We have to report what's left over. How much do we still have that is restricted, and how much do we have that's totally now in the purview of the organization to use as it pleases. Contributions receivable arise because accountants report contributions when an unconditional commitment is made, not when funds are received. And so that means that we have to have the information to report about what's left over and still owing to an organization. These are really the primary specialized accounting rules, and you can see they all have to do about contributions. So important, new fundraisers, in our whole process. What is a contribution? So what does a fundraiser mean when they talk about a contribution? What does an accountant mean? So there's a lot of common ground in these definitions. I went and got the FASB, the accounting standards definition there of a contribution, but I also looked at the one that CFRE puts out in its glossary. So they're not substantially different. They have a lot of the same key elements. Both are transfers, so something's coming from a donor to the organization. They're both voluntary. No one is being compelled to do this. They're irrevocable on the CFRE, which is similar to what we accountants call unconditional. Something of value is being received without there being a reciprocal transfer. You're not giving me money so that I will give you this thing. You're giving it to me freely. Keep in mind, attorneys and tax professionals have their own vocabularies, and that's way beyond my scope. So I'm really only talking about financial accountants when I'm talking about this. So if the owner of a not-for-profit would, I'm sorry, skip that. I'm not going to address that today because there are a lot of aspects of contributions that go beyond this. But if we can realize we have conceptually pretty much the same idea, then at least we know what we're talking about. For us accountants, we don't care what you call it. We talk about resource providers. That's the one giving the funds or the assets. And resource recipients, the one that are receiving. But it doesn't matter what anyone calls a contribution. It may be an agreement, a pledge, a present. It really doesn't matter. If it fits the definition that we accountants say it needs to fit, then we're going to call it a contribution, and we're going to measure it, and we're going to put it into the financial statements according to our rules. And that includes government contracts and awards. And in the past, oftentimes, if it came from a government, it was not called a contribution. But now, under our new guidance, the majority of awards that are coming from governments are now going to be called contributions and follow the same accounting by the accountants in your financial reporting. And it doesn't mean there can't be distinctions between those things. But again, that's something that's important for the fundraisers to understand when they see a line that says contributions, what all is in there. If you're reporting you have a certain amount of contributions and it doesn't include your government grants, you need to understand why your number is different from the accountants. So the first step that we accountants have to determine is what type of transaction we have. Then we're going to know which set of accounting rules we're going to follow. Just bear with me. I know it gets a little technical. I'm going to talk about a resource provider and a resource recipient rather than a donor and a donee, because until we know that we have a contribution, we don't know yet whether we have a donor. So we ask our first question is, did the resource provider and the resource recipient each receive commensurate value? So if they did, there's an exchange going on. If an organization charges $100 for counseling services and the person receives counseling services and those are worth approximately $100, that's not a contribution. An exchange has occurred. When someone pays their tuition, an exchange has occurred because they're receiving educational services. If you are admitted to go to a museum and you pay your fee to go to the museum, your admission fee, well, you have received an exchange. Those are not contributions. Those go completely out of what we're talking about. What we're talking about is someone gives resources and they don't get something of roughly commensurate value. Okay, we probably have a contribution. Let's go on and ask our next question. And again, some clarifications that came out when we're asking that question is whether or not commensurate value has been provided to the resource provider, is that if someone gives you resources for you to provide benefits to the general public, I'm giving you $100,000 so that you can provide counseling services for the homeless. That's not me receiving commensurate value. And it doesn't matter if this is an individual, a private foundation, or a government. If the funds are being given for the purpose of the general public being benefited, that's not commensurate value. If I'm a foundation and I really love education and I give you funds for education and I feel really good about it, that's not commensurate value. It's wonderful when that happens, but it's not commensurate value. So when we're thinking about this, these are some of the things accountants need to understand in these transactions is, as a fundraiser, are you negotiating anything with your donor, with your resource provider that we need to be aware of that they are receiving? So looking at whether we have a contribution or exchange transaction, we need to talk about who's the resource provider, what's the benefit, and who's the recipient of that benefit. So I have a couple of examples here, and I just want to go through very quickly, again, not to kind of overwhelm you with the details, but let's say you have a resource provider, federal government, and they give a grant of $1 million to a not-for-profit, a homeless shelter, to provide counseling services to homeless veterans. Well, the government isn't receiving a benefit in that case generally. So what we talk about is, well, that's a contribution. The resource provider is the government. The benefit provided is the funds, the $1 million, but then the recipient of the benefit is the homeless veteran. A state college and a not-for-profit enter into an agreement, and the not-for-profit's going to study the factors that are likely to impact high school graduation rates. Well, if the results of that study become the property of the state college who provides the resources, then that's an exchange transaction. But in that third case, where they just want that information out there for the general public to understand what are the factors that are impacting the graduation rates, well, then you have the general public being benefited, and you do likely have a contribution. In that last one, you can have not-for-profits who enter into agreements with each other, where one is actually purchasing services from the other. And in this particular case, when you have a not-for-profit that offers counseling services and another one asks you to provide those counseling services, if that's being provided to the general public, that's probably a contribution. If that's being provided to their own clients and it's a service they want to offer their clients, then you might be talking about an exchange transaction. The information that accountants would need to do this evaluation is going to be in some sort of document, and that document is likely going to be generated by the fundraisers, which is why I want to keep making the case that we need to get that information from you. We need to know that our accounting follows your fundraising, not the other way around. Because there's nothing quite so simple, there are times that we have to bifurcate transactions. We actually have transactions that might have an element of an exchange transaction and an element of a contribution. And it's a horrible word called bifurcation, but we accountants do it all the time. Galas is a good example. So people come to a gala, they pay $1,000 for a chicken dinner from a hotel that may be worth, depending upon the hotel, probably not worth $1,000 though. Maybe a couple of hundred, maybe less, maybe more, but not $1,000. So part of that transaction is a contribution. But part of it, the part where they're paying fair value for that dinner, is not. That's an exchange transaction. So we accountants need to understand, is there something being offered that's of lesser value? Then part of this may be a contribution. Organizations give donor status all the time. You know, they have their gold donors, their platinum donors, their silver donors, etc. And if that recognition is just an acknowledgement of your gratitude to your donors, then there's no value assigned to that. But sometimes when you get in those levels of status of donors, there are benefits that go with that. If you contribute a certain amount to the zoo, you get some privileges to visit the zoo. If you contribute to, or we usually call them memberships, buy a membership from a museum, usually there are some privileges that go with that. And so those privileges need to be valued to determine, is the resource provider actually getting a benefit? And in some cases it's no. In some cases it actually costs you more if you paid admission to a particular museum than it does for you to become a member. It's actually a discount to the member. In other cases that's not true. You may be paying a lot more to be a member of an organization than you would pay to just come and be admitted. So again, we need to think about that as accountants and work with you on measuring and valuing what benefit a donor might get. And there are a lot of things you can do where there's no benefit, just acknowledging, putting someone's name on something. Generally, those things are not considered commensurate value. And one thing to stop always and ask yourself is whether or not a payment is voluntary or compulsory. If someone is paying you because they have to, they can't get the good or service, then it's not voluntary and non-reciprocal. So as a grandparent, if I were to pay my granddaughter's tuition, even though I'm not necessarily primarily liable for that, that's an existing exchange transaction and I still have to pay for that. So I haven't made a contribution. Also some organizations ask, well, what if I give a dinner and I don't charge people for it, but I want to raise contributions. I want to acknowledge my donors, but also part of my purpose is to hope that people will make further contributions. Does that mean that I can't say that that's a contribution? No, if you invite people to an event and they are not compelled to pay you anything, you're just hoping they will, or then you can still say that there's a contribution involved in that. I think I already kind of jumped the gun on this and told you resource providers, sometimes they're paying for an underlying transaction. So if you have someone who's paying for tuition, paying for someone else's services that they've received, you don't have a contribution from an accounting standpoint. And you also have to be, again, I'm not going to give you tax advice, but very importantly, is that also tends to be the line that draws whether you have a tax deductible contribution, is whether or not there have been any goods or services that are received. So keep that in mind. Again, the tax has a lot more elements to it than that, but it is part of all of it. Okay, I hope I haven't lost anybody so far, but I keep charging ahead with all this technical stuff. So the next question we have to ask is whether or not there's a condition attached. So we know it's voluntary, we know it's not reciprocal, we're moving in the direction of a contribution, but now we also have to have it be unconditional. And it isn't until we know whether it's conditional or not that we have a contribution, and then we can start talking about whether we recognize it. So what do we mean as accountants by whether there are conditions? A condition is a barrier that your donor, not someone else, but your donor has placed that has to actually be overcome before the organization is entitled to receive the funds or to retain it, because sometimes people will give you money up front, but they still place a condition. And if you don't satisfy that condition, you have to refund the money. So you're not entitled to the money. So that's where we're looking for that line in the sand. When does an organization actually become entitled? And if there's something that they have to do, and that thing they have to do is above and beyond just using the funds for the purpose given, then we probably have a condition, and we as an accountants might say, we are not going to be recognizing that yet. Another difference, because as a fundraiser, you may be putting that in your contribution records. An important thing to do. You want to keep track of that, obviously, but we aren't going to necessarily agree on numbers, because if there are conditions, we're going to wait before that actually enters into the accounting records. So here's our look at barriers and what they are. So we've got this, a donor imposed condition is that barrier that has to be overcome before you're entitled to the assets. And again, you have to give that back if you don't meet that barrier. So what do barriers look like? Well, one of the stronger indications of a barrier is that you require things like a specified level of service or output. Maybe you're going to be given a grant if you can demonstrate that you increase test scores in college freshmen. So we need to, if you're looking at output, I'm going to give you this contribution if you serve 100 people during this quarter. And the language for some of this is very difficult. Are they giving it to you because that's what you asked for? You asked for money to serve, in your mind, approximately 100,000 clients, okay? And you decide, I'm sorry, let's say 100 clients, and you decide it costs about $100,000 for you to serve 100 clients. So you do a grant proposal, and you say, you know, we'd like for you to fund us to do this important work that we're doing. And your grantor comes back and says, yes, we love that idea. Here's your $100,000 to serve 100 people during this quarter. Well, then the question for the accountant is that a condition and they're saying you're not entitled to it until you serve those 100 people? Or was that just them responding to the ask? So bringing this up, because that, I think what you can see is the ask becomes important. And it isn't that you necessarily need to ask differently, but you need to be aware that the way you ask, depending upon how your resource provider responds, might make a condition come into existence that you didn't necessarily mean to be there. This is a communication process, communication in how you ask, but a communication too with how you have your donors respond or how you clarify certain things with them. It may be that they're simply saying, we want this to be used for this particular purpose, but maybe they are saying, we want it to be used for this purpose, and if you don't achieve this outcome, we want our money back. So again, we're looking for entitlement. Is the organization entitled to it? Matching grants, a very classic example of a condition that you're not entitled to your resource provider's match until you've raised an equivalent amount of funds. So sometimes these conditions come there's even an outside event. You may have a donor that says, you know, if I'm able to sell my company for the $4 million that I think it's worth, I'll give you $1 million of that. Well, that's a definite condition, because they're saying this is not going to happen unless and until I'm able to sell my company for what I think it's worth. So sometimes the events that have to occur are within the purview of the not-for-profit, and sometimes they're not. So being aware of that. If your donor or your resource provider limits the discretion in how you use the funds, if they do more than tell you how they want you to use or what purpose they want you to use it, but they want to tell you exactly how to use it, you probably have conditions. This happens a whole lot in government grants, and that's why government grants do fall generally under the contribution accounting, but they aren't necessarily unconditional, because you can't think of anything else that has more strings attached to it than a government grant. But so important to realize if someone's telling you, you have to hire certain people to do this activity, not just you have to do it, then you probably are talking about limits that are going to mean a condition that will preclude, from the accountant standpoint, will preclude that being recognized as a contribution yet until those conditions are satisfied. Sometimes the stipulation is related to the purpose of an agreement. That probably results in a condition, but sometimes it's not related at all. If you have trivial administrative stipulations, then those are probably not related to the purpose of the grant, and they're probably not a condition. If you have to report research findings as a condition of your grant, that I'd say is generally related to the purpose of the agreement and probably will be a condition that has to occur before you're entitled to the funding and before your accountants will recognize it. If you just have to report how the grant funds were spent, that's not a condition. That's just, they're asking for you to give them information. They're not saying you have to do something before you're entitled. Might impact whether you get the next grant or not, whether you report, but probably is not an entitlement factor. If you have to have an annual audit, as much as I will not use the word that an annual audit is trivial, it is not, but we throw it in the trivial and administrative kinds of things. Something that's going on right now that you may be aware of, and again, maybe this doesn't impact you because you're not thinking of it as a contribution, but many organizations have gotten the Paycheck Protection Program loans, the PPP funding, and those are intended by the government to actually result in grants. They don't want the money back. They want organizations to have spent that money to keep people employed and to keep their organizations running. So the reality of those is they will probably be grants. So we're looking at them, though, they have a lot of strings attached. You have to maintain your FTEs. You have to be eligible in the first place, but you have to maintain your FTEs. You have to spend the money within a certain period of time. So those are conditions. And one of the questions right now that is being asked a lot is, when are those conditions met? Is it when you spend the money? Is it when the covered period is over? And I will tell you, I have an opinion as an accountant, but I can't point to the literature, and that is that the reporting that has to be done for a PPP loan to be forgiven is really very substantive in nature. It's not perfunctory reporting of how you spent the funds, but you actually have to be proving how you spent it. So I would say that condition probably is not met until the government actually accepts that and provides your forgiveness. But I realize that's a hot topic right now. And so there's a lot of discussion that's occurring on that. Remember, contributions can be conditional, they can be restricted, they can be both. But what matters is they're going to be recognized in the accounting records when they are unconditional. Whether they're restricted, they'll be recognized. That doesn't stop it, but the conditional does. So if things have to be overcome before you're entitled, it's conditional, not going in our records. But if there's a stipulation from the donor that you use the contribution funds in a particular way that's more specific than the broad purposes of your organization, that's what we would call a restricted contributions, or our new language is with donor restrictions. So if you're a homeless organization and someone gives you $100,000 for homeless programs, that's not really narrower than your broad purpose. So I'd say probably you have every right to call that an unrestricted contribution. If you believe, no, it's very program related, it isn't for overall support of the organization, it must be used only for very particular aspects of the programs, then you probably have a restricted contribution. As an accountant, I don't have the answer to that. Maybe I get a copy of a letter telling me what the donor wants, but maybe some of that came from your conversations with the donor that didn't end up making it in writing. So stressing all along this is a communication process. We don't know it's restricted unless we have the information to let us know that. And that information is primarily going to be coming from you all as the fundraiser. So we want to report these things correctly, because if your donors are relying on the financial statements as at least one source of their information about the organization, they're expecting to see that in a particular way. Okay, when do we recognize contributions? You know, we accountants have a little bit of hubris in us. It didn't happen until we said it happened. So if we don't see it, it's not going in the financial records. So when we have a voluntary, non-reciprocal, unconditional commitment from a donor, we finally recognize that a contribution has taken place. But one of the other rules of accountants is there does have to be some verifiable evidence that this took place. So that's part of our accounting rules. So I have a suggestion. Verifiable evidence does not mean that the donor must put this in writing, and some donors don't want to. You're dealing with them. You know their personality, you know their needs, you know their expectations, wonderful. But it is best practices that somebody put this in writing. So if you get an oral promise from a donor, make a note of that. Put that in your records immediately. Put that in your notes. Follow up with the donor. So, you know, even if it's just a thank you, so they have an opportunity to say, whoa, wait, I didn't mean that. Make sure that there's something in writing that you can pass on to your accountants, that you can hold on to for posterity, that you can make sure and others can help to verify that the organization is being respectful and responsible of what its donors' wishes are, and that things are being reported appropriately. So I make a plug for donor agreements. Accountants don't write them, but we can certainly tell you some of the things that we're looking for in them. You know, contributions arise out of relationships, and a lot of times we don't look at those as business agreements. And so sometimes nobody wants to or is inclined to really reduce that to a piece of paper. But in the end, we're talking about money, and emotions and relationships don't really facilitate good accounting, and they sometimes result in misconceptions and misunderstandings. And so having a donor agreement so that everybody's sure they're on the same page, and that if something comes up later, you've got some legal recourse, if not at least ethical recourse, that you've handled something correctly. So important concepts that we see need to go in donor agreements, that they document if there are stipulations on how they're used, whether it's the time or the purpose, that they provide guidance on whether there are legal or accounting requirements that have to go into this, that there are escape clauses. You know, organizations sometimes last a long time, and they often, or at least sometimes, change what they are doing and change their emphasis and change their focus. They respond to the needs of the community. Well, if you've raised money for a certain thing and you can't go back to your donor and get that changed because they're no longer with us, and now you have to deal with a family potentially who has totally different ideas, have an escape clause. Work on that with the donor. If we aren't able to do this, what could we do with it that you'd still be happy with, so that an organization isn't finding itself having to turn funds over to another organization that can still comply with the donor's wishes, but can continue to have those resources. This protects the donor, but it also protects the recipient when you have things in writing. They can make sure that it's with your sound acceptance policies of what you accept as a contribution, making sure that what you've got here fits within that, and everyone in the organization really wants to buy in to this contribution. One of the things for accountants as well as for attorneys generally is that if you don't have anything in writing, your solicitation materials would guide what the legal and accounting requirements are, under the supposition that if the donor responded to a particular solicitation and they didn't tell you otherwise, that's what they wanted to happen. A few elements that might be different for a building agreement, you know, is talking about naming rights and signage, you know, providing limitations. You know, you may raise, you know, $12 million right now to build a building, and it's got the donor's name on it, and in 20-25 years, that building needs a major renovation. As a fundraiser, wouldn't you like to have the ability to go out and put somebody else's name on it? So be sure you had this with your original donor so you don't unknowingly or unwittingly go out and upset someone when you enter a new campaign that now wants to use the signage or the name or other kinds of acknowledgments. Or maybe you can't use the building at all anymore. Being sure that all of that is understood. What if you raise an endowment for a building and then that building has gotten old and it needs to be replaced? Is that endowment still available so that it can be used for the new building? So putting things like that in writing, and you know, again, more on endowments, being sure that you describe the purpose, that if there are investment policies and spending policies the donors want, that those are written down, or that it is at least clear to the donor that if they don't have specific investment and spending policies, that you're going to follow the organization's investment and spending policies, and that that's okay with them. And that frees you up and frees the organization up, again, to respond to the needs of the organization, especially when there are down markets and endowments are not doing terribly well. And sometimes organizations want to be able to borrow their endowments. That's a touchy subject, and you may or may not want to put something like that in an agreement with a endowment donor, but it might also clarify things. We have organizations that have gone through bad times and they have wanted to use their endowments, and knowing whether or not your donor would be okay with that can certainly help to make that an easier decision. So having these things in writing, again, I don't suggest you have the accountants write it, but these are the kind of things that we see as being important and things that you should work with your attorney or other people in your organization to have sure that they are clarified. The relationship between accounting and fundraising, I just think it's such an important relationship. We're both looking for the good of the organization, and our actions impact one another, how smoothly things work within the organization. And that takes a continuous effort to coordinate that. We need to be independent of one another. That's true. We have different objectives. We need to watch each other and be sure that we are both taking care of the part of this that's in our purview. But we don't want to be detached from one another, and we don't want to be contentious for one another. That is not going to help the organization or us anyway. We really just need to accept accountants aren't fundraisers, fundraisers aren't accountants, and that's okay. You know, the I'm okay, you're okay kind of thing. There are some common differences between us, among others. When we're talking about how fundraisers recognize and record their contributions and accountants do. The government and private grants, some fundraisers report those, some do not. The timing, some development records they want to keep on a cash basis. They're tracking when things come in. If you're following generally accepted accounting principles, you're using an accrual basis, which means as soon as an unconditional commitment is made, then we're recognizing that the contribution occurred, which if the funding doesn't come in at the same time means we have a contribution receivable. So depending upon how you're doing your development records, that might be a difference between us. There is time value. Accountants are so interested in being sure we get the time value of things right, which means if someone is giving you contributions, maybe a stream of revenue or revenue that's not going to come in, contributions that won't come in until the future, even though they may have promised you $10 million, if they're not going to give that to you for 5 years, we recognize a discount saying, well, today that $10 million is not worth $10 million, it's worth $9.6 million. So we might have a time value difference that we're recording that you're not recording. And on that one, I'm just sorry, guys, if I were writing the rules, that would not be that way. It's a silly difference. If I were writing the rules, a lot of these differences wouldn't occur, but they didn't ask me to write the rules. We accountants have to put an allowance for the possibility that some of those contributions receivable won't be collected. We don't want you development people to stop trying to collect it. Please go out there, get it. But we still have to recognize the reality that we may not. So we may have an allowance which reduces the amount of contributions that we reflect from what you all are reporting. If there are donor benefits involved, you might be reporting your special event or your membership dues, something of that nature, and development or membership development is reporting 100% of those dues or that gala payment as a contribution. But we accountants are saying, well, no, we have to bifurcate it. We have to put our exchange portion here and our contribution here. And so we're going to have less contributions than you do overall. Often differences in non-cash contributions. There are, for the most part, in-kind non-cash contributions are recognized in the accounting records. There are a few exceptions though. Contributed services are only recognized if they are provided by a professional who is performing that service, and it's something the organization would have to purchase if it wasn't provided by contribution. That's not the case if somebody gives you things or they give you free rent in their building. Those are recognized at fair value. A lot of times the development records might be keeping track of the fact that someone is making a contribution, but they might not be valuing it. And we have to for accounting purposes. So that might be a difference we have. Irrevocable or revocable agreements. Maybe somebody's told you they're putting you in their will. Yay, that's wonderful. But they've got the rest of their life to change their mind. So as an accountant, I'm sorry, that's just not unconditional. The conditions are the person has to keep you in their will and they have to die. So I hate death accounting, it's hard. So we might have a difference. Again, you might put that in your records because you want to be aware of it and keep it in mind. But we accountants are not going to be keeping track of that. Sometimes there are beneficial interests that are donated, where someone says, you know, I have a house and I want my children to be able to live in it until they are 20 years old. But after that, I'm giving it to the organization. So from an accounting perspective, we have certain rules which would make us put that in the accounting records at a certain value. But the development office may or may not be wanting to keep track of that. So there are a lot of differences that can arise. We just have to communicate about them. We have to be sure that we're hearing each other. There isn't a right and a wrong. There's just different. And we want to recognize that, and we want to be sure that we're communicating clearly so that no one is getting confused and we're not turning off our existing or prospective donors, board members, the public. We've got to be aware and be being sensitive to each other and all that. This is the part that probably does make people's eyes, you know, roll back in their heads, and that is we accountants talk about internal controls. Internal controls are there to keep us all from having fun. No, really not. They're really there to protect us all and to make sure that everybody has the information. So I don't know what language fundraisers would use to talk about internal controls, but policies and procedures maybe. But we want to, providing you things that we think as accountants are good ideas, you know, again, that you have acceptance policies, that you do acknowledge and make sure that things are acknowledged in accordance with the tax rules, in accordance with the needs of the organization, that there's information about the information privacy policies, that you've got gift instruments, that everybody's keeping the documents and they're not throwing them. If you have endowment information, you're not throwing it away after 3 years, that this stuff is acceptable so that everybody can utilize it when they need, that there's some way of receipting the donations. If you're using credit cards, how are those being accepted? How do you keep the assets safe, keep the financial records appropriate and things being reported well? How do you communicate with your donors? Whose responsibility is that? Who's tracking that we've actually satisfied these restrictions that we have on contributions? Who's maintaining that donor database? Very, very important that it's maintained in a way, not that the accountants tell you you have to maintain it, but that so everybody understands how you're keeping your records, how we're keeping our records, so that we can reconcile them. And we've got to work together on that. Either that, or I guess I'm sorry, because what I see happen too often is the accountants tell the fundraisers, you're not doing it right. Well, that right is a matter of perspective. And if we just know how we're doing it and how each other is differing, then I think that we'll be fine on all this. We think as accountants, important things to do is evaluate collectability. Make sure there are procedures for billing. And people hate that word. We don't want to bill people for contributions because, they don't owe it to us. It's voluntary. I get that. So you probably don't want the accountants writing up the invoice for it. But I'd also suggest, as an accountant over the years, what I see success in fundraising is when people are reminded that they have made a commitment, and they're reminded timely, so that they can fit this into their budget, so that they can make sure payments are made, so that you don't come to someone who is forgotten and then you have a situation like COVID. You have a job loss, you have a move, you have an inability to pay a pledge that you might have had the ability to pay last year if you'd been reminded. But again, it's not the accountants who have the smooth communicating skills to do that, but I can tell you it's the accountants who see what is it that's most successful in collecting those contributions when you have a big fundraising campaign. Okay, that is the end of my slideshow. I'm going to try to stop sharing, and I'm going to hope I didn't lose everyone in the room.
No, we still have quite a few folks left. I know we're coming up on noon, but, and thank you, Mimi. That was, at least for me, that was extremely helpful. I have a lot of takeaways from this as a fundraiser. We did have a couple of questions in the chat.
Okay.
So,
I'm happy to stay. I know, but I know that I didn't mean to go over, but this is really fun stuff. Come on. Love it.
Well, in that case, if you don't mind answering, so one question was, is it appropriate for a fundraiser to speak with the accountant before documenting donation confirmations?
Not only appropriate, but actually very, very good. So let me make sure I'm understanding the question. We as auditors send out confirmations to your donors. So is that the process that we're talking about? Or is it just the general process that if someone has made an oral contribution or even a written one, that it's good for the development office to follow that up with some sort of acknowledgement? In both of those cases, I would say it would really be a good idea if everybody's communicating. As an auditor, I have to follow certain rules of evidence, and sometimes I need something from a donor, especially if there's not something in writing that I can rely on. But it's a tricky situation. Auditors, we write these standard letters. You owe us. Do you really owe this organization? Did you really promise this? Blah, blah. Doesn't sound really nice. If the fundraisers wanted to write that confirmation letter, as long as I can mail it and get it back independently, I am good. I don't want to tick off your donors. You can't pay me if I tick off your donors. So I'm real happy to help you with that. And if you're writing a letter to acknowledge, talking to your accountants and saying, what do you want me to put in there so that you are clear? I don't think this is conditional. I don't think that there's any restrictions on this. What do you want me to write in my acknowledgement so that we're confirming with the donor and acknowledging with the donor? That's their understanding too. Or as a fundraiser, no. I know they didn't write that this was for, paying a stipend to the fundraising department, but that's what they wanted. Well, then we'll help you write something that says this so we all know that was for a stipend for the fundraising people who deserve it more than anyone else in the place because they bring the money in. Okay, did that answer?
I think so. Okay, second question was, and thank you, Mimi. Second question is, if we receive a multi-year gift, but are required to submit reports at the conclusion of each year, does that mean that accounting only counts the money once it is received each year versus with fundraisers who count it when the pledge is received? I'm hoping that
yes, absolutely. As an accountant, we are going to recognize the entire amount, no matter when it's due, if it is voluntary and non-reciprocal and unconditional. So we look at that report. Is that report just an administrative thing? Your funder wants to hear back from you. They want to know that you're on target, that you're using the funds for what they intended them. And every funder is going to tell you, if you won't use this for the purpose I gave it to you for, give it back. But when we're talking about conditions, it's a little more than that. It's really, you're not entitled until you do something that's above and beyond just your normal doing it. Again, if you operate a homeless shelter and they give it to you for a homeless shelter and they want to report back at the end of the year that that's what you used it for, that's really kind of an administrative task. But if they're saying, you know what, we want to know that you provided 10 more beds during this fiscal year than you provided last year, and you're not entitled to that money. We're giving it to you, but you're not entitled to keep it, or we're not going to give it to you until we know you're entitled to keep it. Either way, you send us a report that proves to us that you did actually provide 10 more spaces, and then we'll give you your money, or you can keep your money. Those two reports are very different. One is, yeah, we used it, thank you, we're acknowledging. The other is, we had to do something, and we're now proving to you that we did it. So it depends. Whether the report is substantial to the grant or really just an informational kind of thing.
Gotcha. Okay. Well, thank you so much, Mimi. That was it for the questions. So you obviously covered your material very thoroughly.
All right. Well, I've given my phone number, and I saw a lot of the names are our clients, and so you already have access to us. I don't want to get involved with any arguments with your auditors if they're telling you one thing and I'll tell you another, but I can't do that. But at the same time, if you just have questions, I would be happy to answer.
That's great. Thank you. And thank you to everyone who attended today as well. Hopefully you can join us for our next hometown talks next week. It's on diversifying funding. We've got a panel of experts on that topic. It's going to be a webinar with some of our Houston development professionals across several different sectors about how the pandemic has affected their respective organizations. So registration is free. You just head to our website, afphouston.org. I'm going to say thank you to Mimi one more time, and thank you to all of you in attendance. So have a good afternoon and a wonderful weekend. Bye.